If you are planning to retire in 2027, or if you know someone who is, then this video is the most important one you will watch this year. Because between now and the 6th of April 2027, a series of policy decisions are going to land simultaneously on anyone entering retirement in the UK, and when you see them laid out together, it is genuinely difficult not to ask a question that millions of ordinary British people are already asking out loud. How did we end up here? Not as a partisan political statement, not as a dig at any particular party, but as a legitimate response to a retirement landscape in 2027 that is more complicated, more financially punishing in some ways, and more full of conflicting signals than at any point in the past 30 years. Today we are going to walk through every major change hitting new retirees in 2027, what each one means in real pounds and pence, and what you need to do right now before the 6th of April 2027 arrives, because for some of these changes the window to act is already closing. Let's start with the good news, because there is some, and it is real. The full new state pension in 2026-27 pays £241.30 per week, which is £12,548 per year. That is a 4.8% increase on the previous year, delivered under the triple lock guarantee, which operated pensions by average earnings growth because that was the highest of the three measures in the relevant measurement period. Since 2022, the state pension has risen by over 30% in cumulative terms. That is a genuinely significant increase in the incomes of millions of retired people, and it is a direct result of a political commitment to the triple lock that both major parties have, so far, honored. 4 new retirees in 2027, assuming the triple lock is maintained for the 2027-28 rate setting. The full state pension is likely to be in the region of £247 to £252 per week, depending on which of the three measures leads. That is a meaningful income foundation that did not exist at this level a decade ago. But here is where the complexity begins, and here is where the question at the top of this video starts to make sense. The state pension is rising. The personal allowance, which is the amount of income any individual can receive before paying income tax, is frozen at £12,570 and has been frozen at that level since the 2021-22 tax year. It is due to remain frozen until at least 2027-28. The full state pension in 2026-27 is £12,548. The personal allowance is £12,570. The gap between the two is just £22 per year. If the triple lock delivers another increase of 3 or 4% in April 2027, the state pension will cross the personal allowance threshold for the first time in British history. That means that pensioners whose only income is a full new state pension will, for the first time, owe income tax on their state pension income. Not because their circumstances changed, not because they became wealthier, but because one policy, the triple lock, kept rising while another policy, the personal allowance freeze, held everything else still. The Office of Budget Responsibility has described the situation as an unplanned outcome that no government explicitly designed, and yet here we are. The practical consequence of the state pension crossing the personal allowance is not a catastrophe for most people, because hmrc has confirmed that pensioners who have no other income sources and whose only taxable income is a state pension will not have to fill in a self-assessment return or write a check to hmrc. The excess will be collected through pay coding adjustments on any other pension income they receive, or in some cases may simply be written off as administratively impractical to collect on very small amounts. But for the principle of the thing, it represents an extraordinary policy collision. The triple lock was created to protect pensioners' real incomes. The personal allowance freeze was created to raise revenue without technically raising tax rates. The combined effect is that the UK's most politically protected welfare payment is nudging its recipients into income tax for the first time. A former pensions minister described the situation publicly as a complete mess. That is not a party political statement. It is an honest description of what happens when short-term political incentives produce long-term policy incoherence, and it is a backdrop against which everything else hitting new retirees in 2027 needs to be understood. Now let's talk about the single biggest change for new retirees in 2027, which is not the state pension at all. It is what is happening to private pension pots and inheritance tax, and it is a change that has the most immediate and most dramatic financial implication for the largest number of people approaching retirement. From the 6th of April 2027, unused pension funds will be included in the value of a person's estate for inheritance tax purposes. This is the most fundamental change to pension taxation in a generation, and it reverses a position that has been in place for decades. Under the rules that apply until the 5th of April 2027, money left unspent in a defined contribution pension pot generally does not form part of your estate for inheritance tax. That has made pensions uniquely powerful as wealth transfer vehicles. Many financially sophisticated retirees have deliberately drawn income from other savings first, ISOs, premium bonds, investment accounts, and preserved their pension as a tax-free legacy to their children and grandchildren. From the 6th of April 2027, that strategy stops working. From April 2027, your unused pension pot will be added to everything else you own when calculating whether your estate owes inheritance tax. The standard inheritance tax rate is 40% on everything above the nil rate band, which is £325,000 for an individual, rising to £500,000 if your estate includes a residence passing to direct descendants using the residence nil rate band. Married couples and civil partners can combine these allowances, meaning a couple can potentially pass up to £1 million free of inheritance tax, including their combined residence nil rate band. But once your pension pot is added into the calculation, many estates that previously sat comfortably below the threshold will now exceed it. Let's make this concrete with a real example. Take a retired couple who own a home worth £450,000, have ISA savings of £100,000, and have between them an unused pension pot of £300,000. Under the current rules, their estate for inheritance tax purposes is £550,000, the home plus ISOs. With a combined nil rate band of £650,000, they owe nothing in inheritance tax. From April 2027, their pension pot of £300,000 is added, taking the estate to £850,000. Against a combined nil rate band of £650,000, the taxable excess is £200,000, on which 40% inheritance tax is due. That is an £80,000 tax bill that did not exist under the previous rules, on an estate that has not changed. The family's wealth has not grown. The government has simply changed which assets count. A family with no inheritance tax bill today could face tens of thousands of pounds in additional tax from April 2027 simply because of this change. The practical response to this change depends entirely on your situation, and it is one of the areas where speaking to a qualified financial advisor before April 2027 is not just useful but genuinely urgent. The broad strategic options for people with significant pension pots are three. First, draw your pension more aggressively before and after retirement, reducing the unspent amount that will be caught by the new rules, and consider gifting that drawn income to family members using the potentially exempt transfer rules, under which gifts made more than 7 years before death fall outside the estate entirely. Second, ensure your expression of wish nominations for your pension are up to date, because the way your pension is distributed on death will interact with the new rules in ways that your previous nomination may not have anticipated. Third, consider whether reshaping the balance between pension and ISA saving makes sense for your position going forward, because the April 2027 change reduces, though does not eliminate, the inheritance tax advantage of holding wealth in a pension rather than an ISA for people with large estates. What the government has said about this change is that it is designed to prevent pension pots from being used primarily as inheritance planning vehicles rather than retirement income vehicles. The policy argument is that pensions receive extremely generous tax relief on the way in, and that allowing them to also sit outside the inheritance tax net on the way out represented a double advantage that the system was not designed to provide. That is a coherent argument, and a reasonable person can hold it. But the practical reality is that millions of ordinary families who built their retirement savings in good faith under rules as they stood will now face unexpected tax consequences because the rules have been changed near the end of their working lives. The criticism is not that the policy is irrational. It is that it was applied retrospectively to people who made financial decisions based on a framework that no longer applies. Now let's talk about the state pension age, because this is a change that has the broadest reach and the longest timeline, and it is the one where the accusation of poor long-term governance is most directly aimed. The state pension age began rising from 66 to 67 in May 2026, and the phased increase will continue until it reaches 67 for all new claimants by April 2028. For anyone born between the 6th of April 1960 and the 5th of April 1977, this change directly affects when they can first claim. And on top of that confirmed rise, the government has commissioned a new independent review of the state pension age that could result in the transition to 68 being brought forward from the currently legislated window of 2044 to 2046, potentially to as early as 2037 to 2039. For anyone currently in their mid-40s, this means the age at which they access the state pension may be 68 rather than 67, and independent demographic research from the International Longevity Center suggests that the long-run sustainable state pension age given current life expectancy trends and the cost pressures on the system could ultimately need to reach 69 or 70 for younger cohorts. The problem with rising the state pension age is not straightforward. The arguments for it are real. People are living longer on average. The cost of the state pension is over £100 billion per year and rising. The triple lock alone is projected to add £15.5 billion per year to that cost by 2030 according to the OBR. The dependency ratio, which is the number of working-age people supporting each retired person, is deteriorating as the population ages. In that context, asking people to work a year or two longer before claiming the state pension is not unreasonable on pure fiscal grounds. But the arguments against it are also real, and they are grounded in data. Life expectancy in the UK is not evenly distributed. In the most deprived areas of the northeast, parts of Scotland, and certain urban communities, average male life expectancy is already below 67. 16% of UK pensioners are already in poverty according to Age UK. And many people who do manual or physically demanding work simply cannot sustain that work into their late 60s in the way that someone in an office-based professional role can. Rising the pension age uniformly, without any provision for people whose working conditions or health status make it unreachable, produces outcomes that are genuinely unjust for the people at the bottom of the income and health distribution. So what does life actually look like for new retirees in 2027 when you put all of this together? It looks like a state pension that is the highest it has ever been in nominal terms, but that is approaching the income tax threshold for the first time. It looks like a private pension that provides excellent tax relief on contributions, but whose value as an inheritance planning tool has been significantly curtailed. It looks like a state pension age that is rising and may rise further, with unequal impact on different parts of the population. And it looks like a cost of living in retirement that, despite the triple lock increases, still leaves the state pension well short of what the Pensions and Lifetime Savings Association defines as a moderate or comfortable retirement. The full state pension of £12,548 is still $13,000 short of the $32,700 that the PLSA says a moderate single retirement requires in 2026. Is the UK governed by idiots? That is not quite the right question, and it is not one this channel is going to answer with a partisan verdict. What is true is that the retirement landscape in 2027 is a product of decades of decisions made by governments of different colors, each responding to the short-term pressures of their moment, often without fully thinking through the long-run consequences. The triple lock is expensive, but it has genuinely protected pensioner incomes. The personal allowance freeze raises money, but it has produced the absurdity of pensioners potentially paying tax on their state pension. The inheritance tax change on pension pots closes a genuine loophole, but it applies retrospectively to millions who planned in good faith. The rising state pension age reflects a fiscal reality, but it falls disproportionately on those least able to absorb it. None of these decisions, taken individually, is obviously the work of fools, but the combination of them, arriving simultaneously on the same cohort of new retirees in 2027, is a landscape that requires more planning, more professional advice, and more careful financial preparation than any generation of British retirees before them has faced. The practical actions for anyone approaching retirement in 2027 or planning for retirement in the coming years are clear. Check your national insurance record now and fill any gaps before they become more expensive to close. Get a state pension forecast from the government gateway so you know your precise entitlement. Review your pension nominations and expression of wish documents before April 2027 given the inheritance tax change. Speak to a qualified independent financial advisor about whether reshaping your drawdown strategy in light of the new rules makes sense for your estate. And model your retirement income across all three PLSA tiers, minimum, moderate, and comfortable, so you understand exactly what pot size you need and how far you currently are from each of those targets. The retirement system is not designed to be straightforward. It has never been. But in 2027, it is more complicated and more consequential than at any point in recent memory. The people who navigate it well will not be the ones who simply trusted the government to sort it out. They will be the ones who understood the rules, took advice, and made deliberate decisions about their money while the window to act was still open. If this video gave you a clearer picture of what is coming and what to do about it, please hit the like button and subscribe to UK Finance with Peter for more honest, straight-talking content on money and retirement for people living and working in the UK. Thanks for watching, and I will see you in the next one.